do. Now, there's a great book. Who here has read Tony Robbins' book, his latest book on money and making money, mastering money, etc.? Yeah, a couple of people. For those of you who haven't, his first book came out and it was about 700 pages long. It was far too long for me. The latest book's come out, it's an abbreviated version. Okay? And I literally condensed the entire book into one slide. Would you like to see it? Yeah. So the very first one is don't lose your money. Okay, it's really interesting because Warren Buffett goes on and on and on about this. The second one is asymmetric risk reward. Now, some of you will know what that is, some of you won't. In simple terms, who here has heard the higher the risk, the higher the return? Who believes the term? That's complete rubbish. Okay, because asymmetric, the wealthiest people in the world look for the best reward with the lowest risk. Tax efficiency. Robin was just talking about some of the ways to do that. And then the fourth one is diversification. So now it's quite interesting, okay? All of you, well, some of you, you're not all from Joburg, but if you own 3 houses in Joburg, are you diversified? If you own a house in Joburg and a flat in Cape Town, are you diversified? Yes?
Getting better.
Okay. If you own shares on the stock market and you own shares in a REIT, so for those of you who don't know what a REIT is, it's a real estate investment trust, it's a property fund. So if you own shares on the stock market and you own investments in a REIT, are you diversified? Are you? So wouldn't you be surprised to find out that a REIT has a higher than 70% correlation to the stock market? Are you diversified? So what's interesting is that a lot of us think we're diversified, but we need to be diversified across asset classes, within asset classes, across markets and currencies, and across time. Now let me give you a statement quickly. So there's the book that I was recommending, Unshakable, by Tony Robbins. It's a very, very good book. The only thing I don't like about the book is it's for Americans. So the principles don't change, but when he talks about how to be tax efficient, it's American. Is that fair? So Ray Dalio is one of the 50 wealthiest men in the world, and he literally says, all you have to do to be wealthy is you need 15 uncorrelated bets, an array of attractive assets that don't move in tandem, and by doing this it will reduce your risk by 80% and increase your risk-return ratio by a factor of 5. Should we all go home now? You've got it. So what I'd like you to do is just turn to the person next to you and try and decipher what that actually means in English. Does anyone want to share? Does anyone want to share? Anyone want to give it a go? No? Need an expert? Fair enough. Spread your risk. Yeah? Anyone else? Okay, right, so let's just do a quick show of hands. Who completely understands what that's saying? Who thinks that must be only for seriously wealthy people? And who has no idea either way? So guys, let's decipher this into English, okay? One of the comments that I always get is that, but this is only for wealthy people. Because what this actually says is that you need 15 uncorrelated bets. Now, I don't like the word bet, so let's think investment. Is that fair? With an array of attractive assets, so that could be a house, it could be investing in the stock market, just all business, that don't move in tandem. So you need assets that actually move in, effectively could move in opposite directions. And by doing just those 3 things, you will reduce your risk by 80%, and your risk-return ratio, so that means the risk is reducing and the return is increasing, will increase by a factor of 5. Now that's not 5%, that's 500%. So now the question is, if you want to buy a house in Johannesburg, and you want to invest on the stock market, and you want to buy commercial property, and you want to invest overseas, that's only 4 investments. Can you see why until technology turned up, it wasn't available to you and me? Because just the house is probably most of your money if you've got a house. Is that fair? So let's look at how technology can help us change this. The reason